All right, we're back. Tasty Crypto Show. I'm Ryan Grace. And with me today, the one, the only, Katie McGarrigle. Katie, how you doing?
Good. It's been a minute.
It has
been. But you got the memo about the blue shirt.
I got the blue shirt memo, so I think I'm looking okay. You're looking great.
Thank you.
We were off on Monday. I was out sick. We've been gone for the Thanksgiving holiday, so I feel like we haven't talked about crypto in years. But
I know, but I did get some family members asking me about it, so it was almost as if I was with you, and I was trying to impart my very limited knowledge on them. But I'm ready to be the student again.
Well,
I have a lot to learn.
Our goal is to expand your knowledge base here. This is Where Do I Start Crypto, episode 5. It's only the 5th episode. We're not quite at the how do I stop stage of the series. But I want to continue the conversation we did have a couple weeks ago where we started talking about Ethereum.
Yeah.
If you've been following along, we started the series with the basics of crypto. We talked about Bitcoin from the technology perspective. We hit on the investment perspective, the analogy being digital gold. And then last time, we talked about Ethereum as a technology. What is this? A blockchain. It's a technology. It's a cryptocurrency. Why is it interesting? How is it different than Bitcoin? I want to continue that theme, but look at Ethereum from that investment perspective as well.
Sure.
So that's what we're going to do today. Where do I start crypto? Episode 5, ETH Investing. And stop me at any time.
All right. Let's do it.
Real quick, before we jump into it, though, what's up, chat?
What's up, chat?
We're live on YouTube. It always seems like I'm putting down the Tasty Trade, Tasty Live show. I'm not, but there's no live chat. So if you want to jump into the chat, you want to type something crazy in the chat, get over to the Tasty Live YouTube channel.
Yeah, come hang.
Say hi to Katie. Yeah.
Say, I did not get any dip recipes from the people out there.
What the hell?
Speaking of, but it all came together anyways because at the last minute I was put in charge of charcuterie duty instead. So I showed up with a nice little spread of cheeses and crackers and meats and
Kraft singles, roll up some bologna.
Yeah, Kraft singles and bologna. Exactly. Slices of hot dog.
Yeah, it's one of those things where, like, if you don't want to do the job, you just do it in the worst possible way so that you can guarantee not ask it again.
Yeah.
Yeah.
Yeah, there's a term for it too. It's called like intentional ignorance or something like that. So that, like you're saying, they won't ask you to do it again, which is like such a horrible weapon. But I delivered, I thought.
I've been living by that for a good chunk of my life.
You always go above and beyond. What are you talking about?
Oh, thanks, Katie. We got to shout out Lone Sophos real quick in the chat. I don't know if anybody else is in the chat. For us to find out, you've got to type into the chat, but we'll shout you out. So Lone Sophos showing up day in, day out. Dedication.
Yeah. Dedication.
Absolutely. All right, let's do this. I know you got a hard stop at 5 o'clock. So let's get through the show. Ethereum Basics, episode 5. As I mentioned, last week we talked about Ethereum from the tech perspective. Today we're going to look at it from the investment perspective. And I want to set the stage, Katie, by proposing this idea, okay? Ethereum, blockchain technology, cryptocurrency, it's all of these things. And I think this is also true of Bitcoin. I want to think about it as a commodity.
Okay.
Which is tough sometimes because people initially look at things like Bitcoin and they say, well, it's cryptocurrency. I'm not buying anything with it. People aren't using it at the store. It's not a currency. It's not real. Think about it as a commodity.
Sure.
And it might be a lot easier to grasp, certainly from the investment perspective. Okay. So that's...
So if Bitcoin is digital gold, is Ethereum digital silver?
Not quite. Not quite. It's digital something else, in my opinion. It's definitely not a precious metal or even an industrial metal, but it might have some sort of digital industrial use cases, if that makes any sense. So we'll hit on that in just a second. VW Diesel Dork, what up?
What up?
I love this. But to recap, what did we talk about last week? Or if you're brand new to Ethereum, what are we discussing? It's a programmable blockchain, a bit different than Bitcoin. Applications can be built on top of it, and these applications use the network in ways, this is part of Ethereum's innovations, use the network to run automatically. So transactions and data from these applications is securely stored on the network's digital ledger. ETH, the cryptocurrency, the native token of the Ethereum blockchain network, is used to pay for this service and for transacting on the network. And Ethereum's innovations, as I mentioned, allow it to support all sorts of different use cases. We talked about additional tokens, ERC20s, NFTs, so both fungible and non-fungible tokens, decentralized applications we talked a little bit about that relates to DeFi. We'll get into that later on in the series here. And you have use cases then that result from this related to gaming, digital art when we think about NFTs. You think about a recent theme being tokenized real-world assets. There's just, again, a lot more that you can do on Ethereum, or at least that's been true up to this point. There are some things happening on Bitcoin. But to this point, there's just been a lot more that you can do. There's more utility on Ethereum.
Okay, I remember you saying that last.
It's kind of like this, like a digital computer.
Okay.
When you think about it, or a global decentralized compute network. Applications can be built on top of and used as that infrastructure layer or as that settlement layer versus like a centralized server.
Okay, sure.
If that makes sense.
Yeah. There's not just like a central hub in New Jersey.
Exactly. There is the network, which is a distributed ledger, which is decentralized. And we'll talk about how some of that works here in a second. But high level, that's the tech piece of it.
Okay.
That's why it's interesting, or maybe more so, that's why it's different or how it's different than Bitcoin in terms of the use cases. So we go back to Bitcoin as this digital gold. Ethereum has applications that run on top of it. You can interact with the network. You can use it a little bit more so than just transferring value across the network, which is the, kind of the initial use case.
Yeah, and ETH is the way that you pay to play.
Exactly.
So to speak.
Exactly.
Got it.
So all of that said, let's get back to the idea that this is a commodity. Ethereum, when we talk about investing in it, buying the token ETH, the cryptocurrency, is a commodity. So let's talk about some of the commodity characteristics and hopefully tie this all together. Let's first look at the demand side, and then this will get into the investment case. ETH, as we mentioned, is used to pay for the transactions on the network. I'm sure you've probably heard of gas fees. So gas fees are the fees that you pay, the cost to interact with the network. If I want to send you Ethereum or another token across the Ethereum network, I have to pay a small gas fee.
Sure.
Gas fee will be variable due to certain conditions, but generally there's a cost to interact with the network. You pay that fee in Ethereum. I want to use a decentralized application. Maybe I want to go to Uniswap, which we've discussed on the show previously, and I want to trade. I want to swap one token for another. There's going to be an associated gas fee to interact with the network. And you're basically, in a way, paying for that transaction validation, the verification.
Yeah,
the security. Exactly.
Okay.
Nothing's free.
Yeah.
So,
right. I mean, and that's nothing we're not unfamiliar with in the trading world, right? Like, even if you are claiming zero commissions, there are typically pennies or fractions of pennies or things of that nature, depending on what product you're trading, that enables you to actually participate in those markets.
Exactly. And instead of paying this fee to an individual company, you're paying it to the network in a way, is probably the way that I would think about that. So when we get back to the commodity, maybe you can guess at what commodity analogy I'll use here, then I think about ETH as the fuel that powers the Ethereum network.
Okay.
It's used for all of these interactions. The Ethereum network doesn't really work without this fuel. So in a way then, it's kind of like digital oil.
Okay.
So we have Bitcoin, digital gold.
Yeah.
We've got ETH, digital oil, digital gasoline. Or if the Ethereum network is this engine, well, it needs to run on something.
Right.
It runs on ETH.
Okay.
So again, Ethereum network use is the primary demand driver for ETH. And if we go back to that energy analogy, you think about the summer driving season, I suppose, usually gasoline costs go up.
Sure.
There's increased demand.
Yep.
So if more people demand utility or use of the Ethereum network, you could see gas fees go up. As a result, you could see the price of Ethereum go up due to that increased demand. So that's the demand side.
Okay.
Now.
And you're kind of seeing that right now just based on the regulatory environment kind of shifting and people coming in and out of positions of power. So it feels as though there has been an increase in demand, not only for Ethereum, but for other cryptos as well, based on bullish prices alone. And so that's where I'm going to stop, because I'm sure there's way more to it than that.
No, I think that's a fair way to look at it. Or if we believe that, let's put it this way, if we believe that because there's going to be more regulatory certainty, there's going to be more development, more utility and use cases, applications built on Ethereum, and therefore more use of the Ethereum network as a result of all of this, then I would assume we see an increase in the ETH price as it starts to price in an increase in demand.
Got it. Okay.
So that's the demand side. Supply side. Get your, what does Tom say? Get your hard hat out, put your hard hat on, put your helmet on.
Helmet. I think he says helmet.
Yeah. Put your thinking helmet on for this one.
I don't know how he could do that with a beret.
Yeah, well, it's going to get a little bit into the weeds. Going to try to keep this as high level as possible. I think you'll see in a second why maybe we look at the early ETF flows. All this money's going into Bitcoin. What's going on with ETH? Well, it takes a little bit of time, I think, to, you got to spend some time to kind of understand this a bit more. But this is the demand side that we just talked about. Let's talk about the supply side. And in order to do that, I'm going to introduce a couple of terms, a couple of concepts, I suppose, ways that the Ethereum network works. Are you familiar with the term validators?
Not in the sense of the crypto world.
Okay.
I think of it more as somebody who's validating my opinion and or gut checking me.
Okay. That works to an extent here.
Helping me feel a little more secure in whatever action I'm deciding to take.
You're familiar with mining, Bitcoin miners. We didn't really talk about how the Bitcoin network works
and how that
in
cap
that sense.
came to kind of be that finite supply of Bitcoin, I mean.
But we didn't really talk about, I suppose, the security, the consensus mechanism. We tried to stay out of those weeds early on in the series. And we'll get into that in more detail as we move along. But probably the simplest way to think about this is a validator on the Ethereum network is similar to a miner on the Bitcoin network.
Okay.
Both secure the network, validate transactions, verify transactions. So the Ethereum network, instead of miners, uses validators to verify transactions and then adds those transactions to the blockchain.
And is that like a physical person? Is it a wallet? Is it an address? What is a validator?
Well, a validator could be a physical person. I mean, it's not that they're doing something manually, but in terms of how you participate, right? So this is all going to be through the network. It's all online. It's all digital in that sense. But you don't have to be a large institution necessarily to be a validator. You can participate in the validation process as an individual, but it's not a manual process.
Got it.
It does require Ethereum, though. So when you validate these transactions, you earn rewards. Instead of being rewarded in Bitcoin for mining, you're rewarded in ETH for providing this validator service. And so as a result of this, this is going to increase the overall supply of Ethereum.
Right, because if they're verifying the transactions but then making money on top of it, that supply is expanding.
Yes, exactly. So as a function of the network, you have more Ethereum that, I don't know if you want to think about it as coming online, but that comes into existence. So a big difference then when we look at this digital gold being Bitcoin, 21 million, it's in the code. Mathematically, that's all there will ever be. That supply cap does not exist with Ethereum. So then ultimately, people think, okay, this is just going to be inflationary and it's not hard money like digital gold, like Bitcoin. So why would I want to invest in this? We'll talk about some of the other supply dynamics in just a second. But on its own, as validators receive rewards for validating transactions, the supply of Ethereum is going to grow. To participate as a validator, maybe back to one of your earlier questions, you need to stake, what's called staking. You need to stake ETH. To be a single validator, you have to stake 32 ETH. So the price of ETH right now is almost $4,000.
Yeah.
So it's expensive.
For one.
to be a validator, yes, to receive these rewards as a single validator. This ETH is used as collateral. And the reason for this is because you're going to have some skin in the game. So you lock this collateral in place, this ETH, you become a validator. But if you act maliciously, then you risk losing your stake. So there's an economic incentive to participate as a good actor, and bad actors are punished.
Okay, right.
And you could lose your entire stake.
Yeah.
And so there isn't really a scenario where what you would gain as a bad actor would offset what you would lose.
Right, with your staking.
Exactly.
Got it.
And so that's kind of part of the, the economic model to an extent that relates to validators.
Sure.
So I guess what I want you to take away from this is that the supply grows as more transactions are validated. Validators receive rewards. Rewards are paid in ETH. So more ETH comes into existence. The supply starts to expand. So on the demand side, price can be driven by an increase in using the network, but an increase in using the network from this perspective increases the supply of Ethereum.
Okay, and really quickly before you move on, if I do have 32 ETH to stake, am I just like going to an application where I just say I'm ready to be a validator, or like what does that process in a nutshell look like?
There are some ways that you can do that. You can actually join a staking pool where you don't have to have 32 ETH to participate in this process, and I'll hit on that in just a little bit here. But yeah, you basically would have to run and maintain your own node, so you have to have a little bit of kind of expertise in that sense, a little bit of technical expertise. But yeah, you would be, I mean, it's straightforward enough where if you understand how to do it, you can set it up, you can maintain this. But for the, the everyday person, there's also ways that you can participate, stake your ETH, generate some yield, which we'll talk about by participating in the validation process without having to put up the 32 ETH and kind of run the whole thing on your own.
Okay, carry on.
But if you're concerned about the uncontrollable expansion of the supply, there is something that offsets that, and that's important to understand, and that is a burning mechanism. So as we mentioned, when someone uses Ethereum, they're going to pay a gas fee to interact with the network, to use the network. What's happening, though, is part of that fee, the base fee, is burned during every transaction. And that Ethereum, that ETH, is permanently removed from the overall supply. So this burning mechanism, as we have here up on the screen, it kind of acts as a deflationary or disinflationary force, more so, over time. So this kind of, it counteracts the idea or the fact that if there's an increase in demand, certainly the price of ETH could go up, gas fees are going to go up, but aren't also rewards going to increase, or more rewards going to increase the overall supply of ETH? Well, this works to offset this.
Sure.
And we're not going to go through the whole history of the Ethereum network. Just like, we wouldn't start with, hey, you need to learn about Google as an investment. Let's go through the history of the internet. But this wasn't always the case. This is a result of an upgrade, an improvement proposal, and then changes to the network. And I think you had a question before, maybe on the last show, or it's on the slides. It's like, what are these network upgrades? So this is a result. This burning mechanism is a result of a network upgrade, but basically works to counteract supply issuance, and it kind of introduces this disinflationary dynamic. And it can switch between being inflationary or deflationary. It just depends on the amount of activity. And you definitely have these points in time where Ethereum can be deflationary, which is interesting. And so I think from an investment perspective, then it kind of offsets or maybe alleviates the concern around this uncontrollable inflationary supply dynamic versus Bitcoin, 21 million digital gold.
Got it. Okay.
So that said, I've got something here from Ultrasound Money. There are a ton of great dashboards and sources that exist out here, but this will just give you maybe more of an understanding of what the current supply dynamic looks like. So this is the last 30 days. You can see that the supply of ETH has increased by about 0.25%, which, if we just look at this in dollar terms, is running at a rate of about $3 billion at the current ETH price per year.
Okay.
Supply growth per year on a 30-day time frame, 0.25%. And then that burn mechanism is offsetting just a little bit over 2 billion here. And what I find interesting about this and what we've discussed on the show previously is that, again, from the investment perspective, if you were to see very significant inflows into ETH for one reason or another, maybe all of a sudden it's just the regulatory risk has been alleviated, it can very quickly offset that supply growth. And you could get, very large upside moves as a result. In the same way that you could see that with Bitcoin, knowing that there's only 21 million, X amount exists today.
Right.
And if $10 billion were to come into it, it's going to go up a lot.
Right.
Same thing exists here with ETH. It's not just like we just print a bunch more, create a bunch more ETH. There is an entire structure here and model that is going to kind of manage this.
Yeah. So this is literally like 3 steps forward, 2 steps back, almost.
Yes.
In a way. Okay.
Yes.
And but those steps can change based on everything you just said, but this is kind of like what that is showing.
Yes.
In the most simple of terms.
Yeah, it's variable, but I think when you get back to, okay, this is a commodity, in the same way that I want to buy oil or I want to trade an energy company, you need to have some understanding of the supply and demand dynamics that drive the price.
Yeah.
Because that's ultimately going to be the price driver of these commodities. It can get extended one way or the other, but there is something real here that's under the surface.
Okay.
So that's how I think about it as an investment. On the demand side, again, it's predicated on just more people are going to use this network because there's more applications on it. There's more you can do with it. It's, functionally, it's improving. Technically, it's improving or it's upgraded at times. And so, if that's something that people are interested in or believe in, that's the demand side of it. The supply side of it is at times also deflationary, which is interesting and could, result in large upside moves in dollar prices.
Okay.
So that said, another area that I want to hit on from the investment perspective really quickly is the concept of staking. And this gets us back to the validators at the very beginning. So another thing that's interesting and different about Ethereum compared to Bitcoin is that you can generate yield by staking your ETH and actually, as an individual, participating in that network security process where you're going to validate transactions, you're going to contribute to the validation of transactions. And you can do that on your own as a validator, 32 ETH, or through a staking pool. Coinbase is a large exchange that offers staking services. Other exchanges offer staking services in the kind of decentralized finance world. There are DeFi liquid staking pools, and there's a lot that we'll get into over time. But you can participate with a very small amount of ETH. And if you had
this is a way to generate passive income on whatever your investment is.
Yes, because you're going to be generating a yield off of the rewards that are being had by validating these transactions. And the rewards are in ETH. ETH is priced in dollars. So that's where the staking yield comes from. And when you're staking, you're not selling your tokens.
Right.
You're just locking them up. You're depositing them. It's being used as collateral. But I would think of it almost as like a dividend in a way, or maybe more so like a treasury bond.
Okay.
You're kind of lending money to this network, this process, this kind of machine in a way. And it's being used for the network facilitating the process and you're generating yield. And if you're bullish ETH, you still hold your ETH. If it goes up in price, you make money in dollar terms, but you also generate more ETH and kind of grow your whole pie.
Interesting. Okay.
So
and would you say that that's comparable to what you could do with a T-bill?
Absolutely. If you think about the role the US dollar plays as a currency in that financial system where you can lend money to the government and buy bonds, and there's a maturity to that fixed income product or duration to it, I would think about ETH in a very similar way.
Okay.
Right? If this is a financial system, ETH is the currency and staking is kind of lending money to that system.
That is super powerful because I did not know that you could. I mean, you've already made compelling cases for why I would invest, and I have a little bit, a couple $100 in both, but I didn't really grasp that extra perk, I guess you could say, and how it's actually so much more comparable to traditional finance than I think a lot of people realize.
Yes, absolutely. Yeah, I think they're going to have a lot of those aha moments, and I know we're kind of running up against the clock here, but that's the way that I would look at this. I think it's a fair comparison. Really quickly, when we look at why haven't the Ethereum ETFs done as well as the Bitcoin ETFs? Well, maybe part of the problem is that to this point, regulators have not allowed those Ethereum ETFs to stake their ETH. You do not get that yield. So if I am sophisticated enough to understand all of this as an investor and can participate in any way that I see fit as an institution, let's say, why would I buy the ETH ETF that's not going to pass through any staking rewards versus I can just stake ETH on my own?
Yeah. Okay, that makes total sense.
So now, change in regulations, that could be very bullish for this, because now those institutions or those vehicles might be permitted to stake the ETH, and creates a new incentive mechanism to invest in those.
And then would that show up in the form of like an actual dividend on those ETFs?
I would think so. Yeah. I would assume that would be how they would pass it through.
Got it. Interesting.
Yeah. So hopefully we're connecting some of the dots there.
Definitely.
I know we're going to run out of time, but just to give you a sense of what this looks like, there's 34,715,192 ETH staked currently. That's about 30% of the entire Ethereum supply. So now you have this other dynamic where if you're just bullish on Ethereum, if more Ethereum is staked, that supply does become somewhat illiquid. That only really matters if there's a large inflow of capital into this ecosystem or into ETH. But those are things that you want to pay attention to. Additionally, you can see some of the largest ETH stakers here. This is a dashboard from Dune Analytics. Lido is a decentralized staking platform. Coinbase is a centralized exchange. Binance, a centralized exchange. And you can see the amount of validators there, the amount of ETH staked, ETH earned. So, for some of these companies and some of these protocols, it's a very profitable business to participate in this ecosystem. And it just shows you how large it's grown. So those are some of what I think are the interesting kind of investment characteristics if we think about ETH as a commodity. Really quickly, just looking at this to wrap things up, it's done pretty well over the last year, up 72%. If we look at where this is on a 3-year basis, though, this has underperformed significantly. That might change, down 15% over the last 3 years. ETH came out in 2015. Yeah. Has a market cap of $462 billion. So here, we're talking about an entire network that's seeing a growth in participation that's much smaller than some of the biggest companies in the US. This is why I always say it's still early. Right. Doesn't mean that it's going to only just go up from here, but it helps to put some context around these things. Median yearly return for ETH has been 91% since inception. Had some really big years. You've had some years where it's collapsed by 80%, same as Bitcoin. Current 30-day implied vol is 74%. And there's about 290 million estimated global users. So again, to put that in perspective, that's against, let's call it 4.5 billion internet users. Internet usage is growing. It's a very small fraction of internet users that have ever even participated on the Ethereum blockchain network, and certainly a much smaller subset that have ever participated in DeFi. So again, I think there is some room to grow here if this is something that continues to see adoption. So your drivers are going to be your investment drivers are going to be increased adoption, network growth. It is somewhat deflationary or disinflationary at times. It's functional. It can also be seen as a store of value, similar to Bitcoin. That said, it has some risks, scalability challenges, a lot of competitors, the biggest one probably being Solana, which we'll talk about at some point. Okay. Regulatory risk has maybe gone away somewhat versus where we were, say, 3 to 6 months ago. But those are the risks.
I love it. And like I said, I'm already kind of invested, so maybe I jumped the gun a little bit, but
that's okay.
Super compelling. I'm glad that I understand the differences a little bit more now between like Bitcoin and ETH. I think we'll keep expanding on that. We'll start to add in Solana to the mix. I have questions about like liquidity and fills and the traditional things that my trader brain thinks about. So I'm looking forward to our next session.
Awesome. Well, that'll be next week on Monday. I think we'll spend some time going through Katie's questions, recapping a lot of what we discussed up to this point, talking about both of these technologies, platforms, Bitcoin and Ethereum, looking at them from the investment perspective as well. Want to dig into the details a bit more. We'll do that next week. But until then, I'm Ryan.
I'm Katie.
Peace.
Peace.